This past week, interest rates moved higher with the 10-year note yield briefly touching the highest levels of the year. Let's discuss what happened in the past couple weeks and take a look ahead in this week's mortgage market update. The Fed and rate cuts. A little more than 2 weeks ago, Federal Reserve Chair Powell led the world to believe that the Fed will be cutting rates 3 times in 2024. The Fed's dot plot, which is a rate forecast of the Fed members themselves, also confirmed 3 cuts before year end. Now, just days later, and thanks to a hotter than expected inflation report and various Fed speakers, the idea of 3 cuts or even 1 cut is very much at risk. 2 Fridays ago, the Fed's favorite gauge of inflation, the core PCE, was released. The number came in at 2.8% year over year, which matched expectations. So what's the problem? 1, it did not come down from the previous month and remained sticky. 2, the previous month's reading was revised higher to 0.5% for the month. 0.5% annualized means inflation would be 6%, 3 times the Fed's target of 2%. This completely spooked the bond markets and has since put the Fed members on their heels in response. For instance, Atlanta Fed President Raphael Bostic shared that he only sees 1 rate cut in 2024 and that it would be coming in the 4th quarter. Other Fed members have shared similar sentiments. Where were these predictions just 2 weeks ago when the Fed issued its dot plot? After the spike in rates this week, Fed Chair Powell attempted to soothe the markets by suggesting 3 cuts could still happen this year. It's this lack of consensus and certainty and the land of confusion we are in that is helping keep interest rates elevated. Rate cuts abroad. Now, while the U.S. tries to figure out when to cut rates, many other parts of the globe have begun or are beginning to cut rates. The latest this week was the EU, which shared that inflation has moved unexpectedly lower and June might be the right time to cut interest rates. The good news here, as economies around the globe struggle and their interest rates are lower, that puts downward pressure on our interest rates. So while this past week has been very unnerving about rates going significantly higher, there are many factors to consider besides inflation and the Fed. The bottom line, we joke about the land of confusion, but that has essentially been the mortgage and housing world for over 2.5 years now. Questions on where is inflation going, how is the economy doing, and what the Fed is going to do remain unanswered. We do know the old saying, the cure for higher rates is higher rates, meaning as rates edge higher, it attracts investors who buy bonds, which stabilizes rates. Finally, the next move from the Fed will be a cut, and it will probably come sooner rather than later. Better days are ahead at some point. Now, looking ahead this week, it's all about inflation and the Treasury auctions. The consumer and producer price indexes will be released and indicate whether the recent fears of inflation reaccelerating are warranted. The Treasury will also be selling another boatload of new bond issuance to fund our government, and this too can weigh on bond pricing and mortgage rates. As we wrap things up here, here's a peek at current rates to start the week, and feel free to hit pause for the details. And as always, thanks for hanging with me for this week's mortgage market update. Be sure to like, comment, and share. And if you need personalized mortgage advice, I am always here to help. Reach out to me today, and I look forward to funding your future. Have a great week.